Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries that our analysts cover worldwide.
Today, we'll look at why Wall Street's biggest banks reported quarterly earnings that surpassed almost all analyst expectations.
Plus, a look at how the tech company Oracle will commit to the widespread use of AMD chips.
But first, we begin with some big news in the tech sector.
Because this week, the AI research and development company OpenAI signed a multi-year agreement with Broadcom. It is to collaborate on custom chips and networking equipment.
The plan is to add 10 gigawatts worth of AI data center capacity, with the companies beginning to deploy racks of servers containing the gear in 2026.
OpenAI will design the hardware and work with Broadcom to develop it.
For more, we were joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. We first asked Mandeep first take on the latest deal.
Look, OpenAI is going after adding as much compute capacity as they can, and they did first 10 gigawatts with NVIDIA, 6 gigawatts with AMD, and now 10 gigawatts with Broadcom. And the difference here is with Broadcom, they get to use their own chips. NVIDIA and AMD are what we call merchant silicon. I mean, that's basically generalized chips where you can deploy the workload you want, whether it's from OpenAI or Microsoft or any other vendor. In the case of custom silicon, which is what Broadcom does, a company like OpenAI or Google makes up almost 50% plus of Broadcom's AI revenue. So Google has their chip called TPUs. They use it for everything run on Google's platform, whether it's YouTube, whether it's AI, whether it's cloud, everything inside Google's run on their TPU. So OpenAI's strategy here is to use an approach which is similar to Google TPUs because it saves you a lot of money. I mean, imagine an NVIDIA AI chip costs you 30 grand. A custom silicon that Broadcom is making for Google costs you 6 grand. Okay. That's the cost differential we are talking about. Yep. And it's not because NVIDIA has to spend 30 grand to make that chip. They have a 75% gross margin on the chip that they're selling to the customer. So NVIDIA's cost is also low, but they mark up the price of their silicon. Same thing with AMD. In the case of Google, they are going directly to Broadcom to make that chip at a far lower price, and it's for their own use, which is why they don't have to pay the markup to NVIDIA or AMD. And that's why having your custom silicon strategy is so good, because it really saves you. So 1 gigawatt with NVIDIA silicon would cost you about 40 to 50 billion. 1 gigawatt with a Broadcom OpenAI silicon would cost you 25 to 30 billion. So we're talking about a 30 to 40% cost differential, and it's huge. I mean, in the context of what these guys are trying to do, scaled infrastructure.
In addition to that distinction, there's also no investment or stock component to this OpenAI Broadcom deal, which makes it different from the deals that it struck with NVIDIA and AMD. So I guess my question is, how would OpenAI finance the purchase or the chips in general? And
that's a great question, because right now they have to do a lot of financing. It's one thing that's a common thread in the NVIDIA transaction, where even though NVIDIA is putting $10 billion in OpenAI, they still have to find the remainder of the money. So if you imagine, $40 to $50 billion per gigawatt, 10 gigawatts costs you around 500 billion. NVIDIA is only investing up to 100 billion. So they still have to figure out the remainder of 400 billion. In the case of AMD, I mean, yes, they are getting some stock, but you still have to figure out the financing for that, 300 billion or so. Here, it's the same thing. You need the money. And OpenAI's bet is if we keep ramping up our revenue, that is obviously a big source of the funding. We'll do a lot of private deals because we already have the buy-in from these big player, whether it's NVIDIA or Microsoft and other sovereign providers. And I think it's a lot of scale game right now, because once we keep hitting our milestones, we'll keep raising more money. And that's the hope when it comes to OpenAI.
One name I haven't heard during all this dance between all these tech companies is Apple.
Yeah.
What's going on there?
Glaring absence.
Exactly. I think that's the right way to frame it. And look, at some point, I think they're going to go the Broadcom route. Out of the 3 partnerships that OpenAI has had, a company like Apple will never go for merchant silicon. I mean, look at what they have done in their own devices. It's all custom silicon. And that's where, if I had to pick a strategy for Apple, it will likely be custom silicon using Broadcom or Marvell or one of these ASIC providers. But the hard thing for them is, because they have missed out all the action in the past 3 years, it's so hard to catch up. Even if you throw money and, your CapEx dollars, the time is of the essence. And the longer they delay this, I feel either it's Broadcom or a partnership with Google now that antitrust is behind. So they may very well adopt Google's LLM across their
that would
device.
Be huge.
That will be huge. But I think with the regulatory overhang going away, that could be a very likely strategy.
Apple has a ton of cash. It can't buy its way to a solution here.
Who do you buy? I mean, these are all scale players.
I'll put a deal
AMD,
together.
Broadcom, maybe you could say Marvell is a smaller player, but you need the best end chips. That's why everyone is buying NVIDIA, because they have the highest performance per watt. So you can't really get a second or a third player, because then you compromise on the performance per watt when the biggest constraint out there is power. So, you need the leading player when it comes to the chip side of the equation.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We move next to corporate earnings from the pizza chain Domino's.
Domino's reported better than expected third quarter earnings this week. They were fueled by demand for promotions and the stuffed crust pizza.
For more, we're joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst.
We began by asking Michael to break down the latest results.
It was a great quarter. I mean, 5.2% same-store sales in the U.S., and everyone knows quick service restaurants, have been struggling due to low-income consumer weakness. They did it with stuffed crust pizza. They were the only major national pizza chain that did not have stuffed crust pizza, so they added that to the repertoire this year, and that's boosted sales. Value this quarter was the best deal ever. $9.99 for any pizza, no matter how many toppings you want on it, right? So giving people a discount that they really want on an item they really want. And then, DoorDash. This is the first quarter they were fully rolled out on DoorDash, and that has really helped them take a chunk of that third-party delivery aggregator business, boosting same-store sales.
Okay, that all makes sense, but is that sustainable, especially the promotions like $9.99, which definitely sound appealing in this day and age? I mean, these campaigns might drive volume, but at some point, don't they erode profitability?
Well, I think, what we saw was margins were flat, so to your point, but what management said and what they're right about is that, you don't take margin to the bank, you take dollars to the bank, right? And so they did this $9.99 deal, and they actually ran it longer than expected because franchisees were making so much money off of it, right? And so, they're willing to sacrifice a little bit of margin expansion here for that traffic because it's making franchisees happy, and that's the key when being a franchisor. So I think this is sustainable, right? They have only a fraction of the third-party delivery business, right? But they have a third of the pizza market in the U.S. So that's a huge slug of business that we think is a great opportunity that's going to continue to build over time. Uber Eats, it took them quite some time to build some momentum there. This was just the first quarter of being fully rolled out on DoorDash, so we think it's going to have a big impact over the next 3 quarters. But it sounds like it can continue to build. Stuffed crust pizza, right? This is something that's a permanent menu item. This is not something that is, just a limited time offer that's going to be run for a few weeks, right? And then value. They have a bunch of different value things. They do these boost weeks, and they have a tip promotion, and so they run different value at different times. But what they've done is been able to create a name for themselves and are owning certain type of discounts that they run throughout the year. And so I think that is important for national pizza players. It's a business that's heavily weighted toward low-income consumers. And, to my point earlier, they're struggling right now.
So, Mike, explain the economics or explain the strategy of using these third-party delivery folks like Uber Eats or DoorDash. What changed for Domino's, for example? Why would they not use them, but then make the decision to use them?
Yeah, great question. So, at first it was really about the cost, right? And years ago, third-party delivery companies were charging 30% plus. Domino's, number one, they waited till the prices came down. Also, their business is really just using the marketplace. They're still using their own delivery drivers, right? And so they're able to use DoorDash only for their marketplace and pay a much, much lower VIG to the company for the listing, right? And so they were the last of all the major pizza players and QSR names. They were the final holdout. A big part of it was they were just so big in delivery and they didn't want to cannibalize the margin on that business. But what we're seeing is it really drive transactions. This quarter, we saw a positive same-store sales growth with carryout as well as delivery. They saw same-store sales growth with every income cohort. It was a very strong quarter across the board.
You can count on people to not want to get off their couch and always order in, and that's guaranteed moneymaker.
The only offspring that's still on my dole is my last guy. He's in college, and he knows he has to call me or text me.
Does he?
To get pre-approval to use any third-party deliveries, because I hate that cost.
Yeah, I mean, well, as Gen
cost.
Xers and older, the thought of paying out extra for someone to deliver food to you is just.
So I haven't heard from him in like 6 months on this.
That's
issue.
good progress.
Yes. Yep.
So, Michael, is Domino's attracting higher income consumers who are perhaps trading down and looking for those deals like the $9.99 pizza? And I wonder how much more market share they can pick up that way.
Well, same-store sales, to your point, did grow with higher income consumers. They didn't talk about whether that's a trade down. Naturally, though, you will see that from increasing your third-party delivery sales, right? Because those customers tend to skew younger and skew more affluent. So we do know that's going to... Yeah, exactly.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst.
Coming up, a look at how the luxury goods maker LVMH unexpectedly returned to sales growth last quarter.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We turn next to U.S. bank earnings.
This week, Wall Street's biggest banks reported third quarter earnings that surpassed almost all analyst estimates.
They included Goldman Sachs, Bank of America, Morgan Stanley, JP Morgan Chase, and Wells Fargo. The results were driven by deals, investment banking, and market volatility.
For a closer look at Bank of America and Morgan Stanley, we were joined by Alison Williams, Bloomberg Intelligence Senior Analyst for Global Banks and Asset Managers.
We first asked Alison what she made of Morgan Stanley's quarterly results.
Obviously, it's a strong environment for equities, especially the third quarter was a very strong environment. We hit records multiple times, including in the end of September. We had new records earlier this quarter. But, as we know, when you manage a team, when you have that strong environment, you want people that are going to take advantage of it. And I mean, equities trading really jumping. We saw strong growth actually at JP Morgan and Morgan Stanley. Goldman trailing a bit. So raising maybe some questions about what happened there, but also equity fees, Morgan Stanley doing well. And then the wealth business. I mean, that's really the focus for investors. Those flows really strong.
Yeah, wealth management net revenue of $8.23 billion. It was estimated to increase 7% to $7.78 billion. So that was a big, big beat. And this is the part of the business that Morgan Stanley has really been focused on to kind of separate it from Goldman Sachs, because this is the steady Eddie business where it's fee generated, it's recurring. You're not dictated by the whims of the market and volatility and anything that could happen in any quarter, right?
So to your point, the wealth and asset management tends to be more favored by investors because it does tend to be more of a recurring revenue model. Obviously, if the market goes down 20% or up 20%, that has an impact on fees. but it's not comparable to something like the underwriting or the pure transactional business. Recall the pandemic when things completely shut down. I mean, granted, they recovered, but the fact of the matter is, like, it's less volatility, more recurring revenue. Investors like that fee income, and they like sort of the relative stability of that business.
So one thing that really jumped out at me, Alison, when I was looking at the earnings is the fact that all the banks provision for credit losses. JP Morgan set aside more than what analysts thought it would set aside. Goldman Sachs set aside less. Morgan Stanley was estimated to have set aside $97 million. It ended up setting aside zero for bad loan losses. What does that say?
They did, and I mean, for Morgan Stanley, lending is such a small part of their business. It's the least out of all the banks. So if you're going to see zero, you would see it there. But the one question we do have, which I think will become clear as we see many of the other banks report, is we're seeing a very strong consumer at these big banks. But is there differentiation in terms of the high-end consumer or lower-income consumer? A lot of these banks, the focus really is on the higher-end consumer. JP Morgan, despite a lot of the headlines that came out from Jamie's comments, we look at the credit card business and the credit trends in that business, super strong. Their charge-off rate, they actually guided down because they had to, because the delinquencies are coming in, so much lower. We know that JP Morgan really focuses on that Sapphire card, that high-end card. So they are seeing a strong consumer. But will we see something different when we see some of the other card companies report?
When you think about it, the drivers of the investment banking business are pretty darn simple. Listen to Chief Financial Officer Alistair Borthwick. Here's what he told analysts on Wednesday, quote, "We've seen more certainty now around trade and tariffs and around taxes as well. It's allowed our client base to make longer-term decisions. That's reflected in our investment banking activity." It's as simple as that. But again, it's hard to predict kind of what those macro trends are going to be. Switching gears to the Bank of America, their bankers did really well. Not that that's a surprise, but they put us a big growth rate.
They did, and to your point, Paul. I mean, you've been in this business, right? So having clarity is generally helpful for the investment banking business. That's why we did see sort of a fall off mid-year. But what we've heard from the banks and their bankers is that, look, clients are beginning to accept that there is some level of uncertainty they'll have to deal with. It's not going away necessarily anytime soon. So if you need to come to market, now is probably a good time. And by the way, record equity prices, Fed cutting rates, those are also helpful in bringing some of those deals to market. Bank of America, by the way, talking about their backlog up very strongly for the fourth quarter. So this momentum into this next quarter is likely to show up again in the fourth quarter results.
So for Bank of America, it feels like investors were singularly focused on the net interest income number because it had not done so well just a year ago. And Bank of America was really focused on improving that. This was a big beat on the NII number here, and they actually guided higher for the fourth quarter. The bank is going to hold its first investor day, I think since 2011, next month. How does this set up Bank of America for this investor day?
So I think they are set up well for the Investor Day. And keep in mind, Investor Day will be focused, I think, on the long-term trends. We have gotten some management changes, some announcements related to succession planning. And I think, Brian Moynihan has done a great job with the bank. I think the Investor Day is really going to be focused on, what is the look forward. And AI is something that we've heard a little bit about Bank of America talking about that this quarter. Goldman Sachs bringing out their 3.0 program. Morgan Stanley actually had been talking about that with their cuts last year. How is AI going to contribute to the structural profitability of Bank of America? So cyclical, some very strong trends this quarter. Structural, they've done a good job, but what is next for the bank?
I mean, I just forgot how big Bank of America is, and they grew through so many acquisitions. 213,000 employees. It's got a market cap of almost $400 billion. They seem like they've got the right mix of assets at this point.
Yeah, so to your point, they did grow a lot through acquisitions under prior managements. And I think, what Brian Moynihan has come in and said was they're really going to focus on organic growth. They focus on the strategy, responsible lending. There's some noise around that when times are good, right? Because everyone said, well, are you being too conservative? But then when times are bad, that is really helpful to managing the downside. And that's one of the things that I think can give investors comfort as we worry about recession risks in the coming quarters.
Our thanks to Alison Williams, Bloomberg Intelligence Senior Analyst for global banks and asset managers.
We move next to earnings from the luxury goods maker LVMH.
This week, LVMH reported third quarter earnings that beat analyst estimates in all 5 business units after 2 quarters of declines. The rise in revenue and China sales also suggest that the slump in luxury demand might be easing.
For more on this, we were joined by Deb Aitken, Bloomberg Intelligence luxury goods analyst.
We began by asking Deb for her take on LVMH's results and whether it signals that luxury is back.
Really a very big sentiment indicator. The comments from the company were more positive than the market anticipated. When we look at the numbers, in terms of the organic sales growth, the market expected around -1. We came in at +1, but it's about the sequential improvement from Q2 to Q3. And the fact that all 5 of the business units improved versus Q2. And more than that, China is mid to high single digit growth versus a year ago. The US is robust. Europe is doing the same as it did across the board, doing okay, but missing out on tourism. And Asia ex-Japan is positive. We know 4Q US will face a bit more of a difficult comp after the spending last year beyond the election and the Trump win. But into the first half of 2026, the market is looking more positive, and it's certainly rallied the whole of the sector this morning and this afternoon.
Hey, Deb, what's the correlation between luxury spending and just kind of the broader stock market around the world? Because markets are really performing well. How does that correlate to just luxury spending?
The big thing on luxury spend has been that the very high end has done well. So Hermes, Brunello Cucinelli, where they work with a restricted volume operating model, they've done well in terms of their top line growth. But when I think about an LVMH, given how big they are, they need a big volume there, even with some pricing, to manage growth in this category. And instead, what we saw last year and the beginning of this year was maybe a little bit of trading down. So brands like Tapestry's Coach, Ralph Lauren, they became really so popular, not only in the US, but more on a globalized basis too. And so the view has been that the sentiment around the share prices has very much been opposed and opposite to what's been happening on the stock market. But with the exception of the mid-range, and the mid-range have done better because the view in the investor mindset has been that the luxury buyer will trade down. They've done that in some brands, but not all brands, in some categories, not all categories. And generally, we expect the biggest and the best to come back first.
What about LVMH's wines and spirits division? We've been hearing from Constellation Brands and other spirits companies that, there's been this massive shift in consumer tastes away from alcohol, certainly the younger generation. Does that affect a company like LVMH?
So a different kind of thing with LVMH. I think at the very high end, we had some US weakness. So they operate in wines, fine wines, high-end champagnes, cognacs, and others. Champagne is doing well and is back to growth in the US. Rosé wine is doing very, very well. But some of the spirit side is still struggling a little bit. And I think that's because we've seen some trading down. So we had China very heavily stocked and the US not so solid through the first half of the year, but there are signs of that coming back. If I look at the numbers on the Q3 for wines and spirits, they're at +1 and they were at -4 for Q2 and -9 for Q1. So it seems as though inventory is leveled out and we're starting to see some sell-in.
Deb, I learned from you long ago when looking at luxury, you have to also pay attention to what's happening in China and the Chinese consumer. Are the Chinese spending either in China or are they traveling to the London, Paris, New York, Milan type thing? What are you seeing?
Yeah, we're still seeing a lot of the spend. We're getting mid to high single digit growth in that Q3 from LVMH year on year is on localized spending. We are seeing pockets of growth on the tourism side, So there is a more positive view and mix linked into the commentary from these results. But overall, we are still absolutely missing Asian tourists, Chinese tourists from Europe. And also in Europe, we're missing the strength of the dollar having swung over last year with US purchases here. And you are seeing some, but not as many in terms of full recovery versus 2019. There's growth year on year, but not versus 2019 into the US either when it comes to the Chinese tourist. We used to say a third of luxury goods, just over, were from the Chinese cohort, and that would include on land and traveling, right? And we still think there's a way for that to go. But certainly on land and locally, they're doing better than they were.
Our thanks to Deb Aitken, Bloomberg Intelligence luxury goods analyst.
Coming up, a look at why the global snacking company Kellanova is adding a jolt of protein to its biggest snack.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move now to news from the consumer goods sector.
Because this week, the global snacking company Kellanova announced it'll offer a version of Pop-Tarts with higher protein content. This will begin in November.
The news comes as companies start to add protein to food with hopes of luring shoppers who've moved away from highly processed products.
In other news, the retail giant Walmart announced a partnership with AI research company OpenAI. This deal would allow shoppers to browse and purchase its products on the AI chatbot ChatGPT.
For more on all of this, we're joined by Jen Bartashus, Bloomberg Intelligence Senior Retail Analyst.
We began by asking Jen for her take on Kellanova's protein boost.
Really what we're seeing is a lot of these packaged food companies are tapping into this protein trend. It's something that consumers are really looking for. And at the end of the day, when it comes to PepsiCo or it comes to Kellanova, this is really about making people feel marginally better about eating food that is bad for them, right? Let's just be honest about it, right? So, when you put protein on the package, people feel like even if they're making a bad choice, it's not as bad as it could have been. And that's really what's behind this.
It's like the equivalent of vanity sizing at retailers, right? You're actually a size 6, but we're going to tell you you're a size 2, so you feel better and buy more clothes. Is this as simple, Jen, as just adding protein powder on top of the Kellogg's Pop-Tarts? Kellanova Pop-Tarts?
Yes. So what they've done is they've added protein into the pastry part of the Pop-Tart, and that changes the texture and the taste just a little bit. But what's really interesting is the consumer trend behind it. We ran a proprietary protein study back in the middle of the summer, and what we saw was that almost 40% of consumers eat something with protein enhanced, whether it's a snack or a beverage, on a weekly basis. And at least 38% said that they're eating more protein enhanced products in the last 3 months. So clearly there's a consumer uptake, there's interest in this, and that's what these companies are really tapping into.
Do I want more protein? Do I need more protein?
I'm eating more egg whites, but that's because it's available at work. What are you doing?
I don't know. I'm using the same thing I've always done.
Your goldfish do not have extra protein on them.
Goldfish do not have extra protein.
Listen, neither of you are on GLP-1 drugs, right? But protein is a big solution for people who are on those drugs because you tend to lose muscle mass as a side effect of those drugs. Wow. And so as the uptake of GLP-1 goes up, there's more and more demand for these protein-enhanced products.
That's what I needed. Okay, now I'm at a cocktail party, and I need to sound smart on proteins. Now I got my line.
But apparently fiber is the new protein. And Jen, didn't the PepsiCo CEO say something about this?
Yeah, whether it's anything that helps kind of enhance the product. So when you talk about Doritos, so they have additional milk protein being added, higher fiber products. All of these things are things that the average consumer perceives as having a health or wellness benefit, and people are trying in small steps to be a little bit better about their health.
All right, let's get to another story I thought was really interesting. Walmart partners with OpenAI to offer shopping on ChatGPT. This sounds like a natural. What's going on here, Jen?
Yeah, this is an interesting move, but I think it really illustrates sort of that trend of what's happening across retail in general. Walmart's really been very good about doing experimentation and kind of checking out what the opportunities are, whether it comes to social media, and social commerce particularly. And this latest partnership with OpenAI, this really does tap into that as well. Now, social spending is still very small in terms of the overall percentage of what retailers are achieving, but it's important to be present. And I think that's what's most notable about this announcement.
What is social spending, and how do the numbers differ from normal shopping through Walmart's website or going into Walmart's actual stores?
Yeah, so social commerce is when you're on a platform, whether it's on ChatGPT now, or whether it's on TikTok, or whether it's on Facebook, or any of the social media platforms, and you have the ability to add to cart and buy now. That's social commerce, but it's still a tiny fraction of the overall e-commerce that happens for these companies. So while it's important in terms of their showing that they're present and that they're aware of new technologies, it's not going to move the needle with regards to their overall e-commerce sales or their overall business mix at this point.
Jen, we've got a little bit more data, a little bit more time. And as it relates to tariffs, what's your best guess as to what your packaged food companies, your retailers, how are they kind of segmenting the tariffs and before maybe passing along something to the consumer?
Yeah, it's a complicated situation, Paul, and really what's happening is, where they can find alternative sourcing, a lot of companies have been trying to do that. There are some companies in packaged food where that's not as easy. So I would take McCormick as an example, where a lot of spices you can't produce domestically or you can't source domestically. And then it becomes a question of how do you negotiate with partners? Do you find alternative countries of origin that maybe have slightly lower tariff levels? And it's also a lot of effort right now is going into finding efficiencies that can help offset those costs so that they can absorb some of that cost and not have to pass it on to consumers. Ultimately, most of the companies we're talking to are saying that where needed, they will very strategically pass price through, but they're trying to avoid a unilateral price increase just due to tariffs.
How much of this work has been done, what you just described? And I guess I wonder how much of it will be covered in the earnings calls this quarter.
I think it will be definitely a topic of the earnings calls this quarter. But when we had tariffs back in 2018, a lot of companies started the process of identifying other options for sourcing. So there's probably been more progress made than people would recognize because it didn't just start this year. And so it's been sort of a gradual shift. And once they have those plans in place, they can sort of accelerate that. And then the focus really is on efficiencies. And that's where the technology comes back into play, where it helps them be better with regards to their sourcing, their negotiations, and really in terms of understanding what products they actually need to carry and which products they could perhaps suspend or discontinue.
Our thanks to Jen Bartashus, Bloomberg Intelligence Senior Retail Analyst.
We move next to news in the tech sector.
This week we heard that the chipmaker Advanced Micro Devices received a major order from Oracle for its new AI chips. This announcement is part of a frenzy of deals by big tech and AI companies.
And in other news, the cloud-based software company Salesforce expanded its partnership with OpenAI. This will allow companies to access Salesforce's Agentforce app in ChatGPT, enabling instant checkout in its commerce platform.
For more, we're joined by Anurag Rana, Bloomberg Intelligence Technology Analyst. We first asked Anurag if the recent deal between AMD and Oracle is unusual.
The slight unusual part is that the AMD chip seems to be doing at parity at what NVIDIA chips are for this particular case. Now, I do not know what kind of workloads Oracle will put on it, so you really can't do an apples-to-apples comparison. But the story at this point is Oracle has a massive backlog of orders, and it needs to invest money to get them converted into revenue. They need to open more data centers or rent out more data centers. They need to buy more chips, buy more hardware, and combine all that together. And eventually, then they're going to get paid for all that stuff. So they're going anywhere they can find chips right now. And it seems that AMD is their next stop.
So there are a couple of threads to pull on there. It feels like AMD is increasingly the number one alternative to NVIDIA's chips. We can talk about that in a little bit. But what struck me is that there's no dollar amount disclosed in this deal or partnership or promise. The previous deal that AMD struck with OpenAI just said tens of billions of dollars in new revenue. Why are firms keeping it so vague?
Well, because they do not know at how many chips they would need, at what point, at what capacity. This is that's not, it's more so signaling that we are not just truly dependent on NVIDIA. We have other options as well. It helps them with navigating in terms of pricing from NVIDIA also. We know NVIDIA chips are getting expensive over the last few years. So there could be one reason. The other thing we don't know is what kind of workloads there are, because we know for the absolute best of the best, you have to use NVIDIA chips. That's what we know. Whether all of that changes in 12 to 18 months, we don't know. But there are other workloads that may not require that amount of, firepower or horsepower, you could say. For that, you may use, AMD chips or something even more inferior.
And even yet another announcement in your space, Anurag, Salesforce, a company you've been talking to us about for many, many years. Salesforce and OpenAI announced an expanded strategic partnership. What's going on there?
Yeah, so for me, this is actually a far bigger news and has more ramifications in the long run. If you see what's been happening in the software landscape over the past 2 years, the threat is that OpenAI will come and it'll take away, basically the businesses of all the application software vendors, whether that's Adobe, Workday, Salesforce, HubSpot, you name it. Because OpenAI has shown capabilities that their model can help out in functions such as finance, human resources, sales automations, etc. This integration between the world's biggest CRM software vendor, which is Salesforce, and OpenAI shows that both of them will be working together, and it'll be easier for enterprises to go inside OpenAI ChatGPT, ask for what they want. That gets connected to the data that resides in Salesforce, makes it very easy for the enterprise customers to do their work as well, rather than just going into Salesforce. So I think this is a bigger news in the long run, but we are all talking about Oracle as well.
Yeah, OpenAI announces a new deal with someone every day, Paul. This is kind of what you're getting back to. And this really, both of these announcements are the latest in this string of big tech building more computing infrastructure and meeting this demand, this insatiable demand. I've really lost track of the permutations. Anurag, what worries you about these back and forth announcements and partnerships and the billions of dollars that may or may not change hands? Do we think that these are just announcements that may not come to fruition if circumstances change, for instance, in the next 6 months?
See, from a Salesforce point of view, and which is what I was, you would say most of us are worried about, also legacy software names, it's a good thing because OpenAI is a new channel of communication with, the rest of the world. If you can integrate your product with them, it kind of saves you from getting disrupted. The question is, in the long run, and then we'll find out what happens is, will OpenAI have that much level of funding to keep up with all the promises that they have? They have given very high revenue estimates for the next few years, but at the same time, the rest of the bigger, tech vendors are not, just sleeping at that point, I would say. We'll find out whether OpenAI will be able to gain market share from the likes of, Microsoft, Apple, Google, and Meta or Amazon, or this is going to be just an expansion of the overall market.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.